Today we're going to talk to you about how to stop capital in a whole life insurance contract and leverage that contract to invest in real estate. More on this strategy from my guest, Harper Jones, coming up.
Welcome to the Wealth Through Real Estate Investing Podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and to reach the lifestyle you always wanted. And now, your host, Dwaine Clarke.
Hello and welcome back to the Wealth Through Real Estate Investing Show. This is your host, Dwaine Clarke, and today we have Harper Jones. Harper is with CreateTailwind. Harper, thank you so much for joining us on the show, and how you doing, my friend?
Hey, I'm doing great. Thanks for having me. And I got to say, that intro you had was really cool. We're trying to do a better intro with our Breakaway Wealth podcast that the founder of CreateTailwind, Jim Oliver, started years ago. And we're trying to get some ideas, and I really liked how you did that. So I got to ask you.
Awesome.
Yeah,
definitely. Absolutely. Yeah. Just been inspired with all of the many guests that we have on. We, interview all different thought leaders and all of the real estate experts in the industry to kind of give all of our guests kind of the inside track on how to best take their strategy to the next level. And that also includes you as well. So I appreciate you coming on to talk about a strategy that is not really covered a lot. I don't hear much. I started kind of learning about this last year, and especially as I started to kind of prepare for these interviews and just kind of dig more deeper into it. And I kind of mix it with my real estate business. I'm like, why haven't I heard about this much, this infinite banking strategy? And so I'm glad you're on the show to kind of talk about a bit more. But before we get started, can you kind of talk about kind of your background and how you got started in this industry?
Yeah, for sure. So I got my start with real estate maybe 4.5-ish years ago, and started to realize that a lot of people that have built long-term wealth, or people that were wealthy, had or have assets within real estate. So that's what kind of motivated me to learn more and figure out how can I start being involved in that space. So as I tried to find some mentors or people that were doing what I wanted to do, one of the first things I started out doing was wholesaling, where you're kind of flipping the paper, kind of bird dog properties, be the middleman, so to speak, and then send it to different investors that you built relationships with, and you make the money, the spread there. So say there's a house for 100 and the investor would pay 120 and there's enough spread for him, then you would make that 20 grand. So I had this one partner, John, I started with, worked maybe 6, 7, 8 months with him, and then kind of split off on my own at that point and did some more wholesaling with some more partners for another year or so. And then we bought our first rental property, which was 7 units, and another rental property, which was 6, and then so on and so forth, where we got to about 100 rental properties, had a couple partners, a couple investors, so I didn't just solely own that, and started learning the ropes of rentals, self-management, having some investor capital and other, joint partners within that space. And then we've done a lot of A to Z transactions now. Not that that's a massive number of apartments or deals we've done, but we've taken some from A to Z, completed them, and had good projects. So we've had learning experience through that. So now I still own a couple dozen rental properties. I'm a little bit more liquid since we sold a lot of stuff last year. And I would say a couple years in, that's when I had discovered the infinite banking concept from Nelson Nash, his book, Becoming Your Own Banker. And I became passionate and wanted to implement it in my own life. And as I kept studying it and educating myself, others took interest as I was just talking with them. And then they wanted me to start setting up policies for them and coaching and teaching them the concept and how they can use it alongside their investments in their day-to-day. So now I do that for my full time, but of course my capital, I'll continue to invest and still do other, flips, wholesales, and acquire rental properties and real estate.
Awesome. And as far as kind of like as people are starting to become more aware of this this concept and really take advantage of it to really build capital, kind of like with all of the really ultra rich families did it in the past. Can you kind of talk about kind of like the why you guys decided to take a total different approach to advising clients compared to the traditional where they'll get them into these policies where it kind of trap their cash and things like that? And why aren't more financial advisors, also advising people to do this as well?
Yeah, well, Nelson Nash said, if you really know what's happening, you'll know what to do. And, I believe that anyone who fully understands this concept and fully understands the power of a specially designed whole life insurance contract and the benefits that come with it are going to look to implement that in their life whenever, they see fit, when they have the capital to start flowing into the system, right? And traditionally, like Jim with CreateTailwind, when he founded CreateTailwind, I think it was in 1988, and he started off as a full service financial advising firm. And I think he had like 700 million or so under management. And he ended up selling that off because he realized that he was making consistent money. And they would say that the clients were making 7, 8, 9%, but they really were making less than that. And I wasn't involved at that point at all, but Jim was saying, hey, I want to be more specific on showing them how they can take control of their flow of money versus me controlling the flow of money, right? And then, taking fees and so on and so forth. We want to put that banking function back at the you and me level. And so he started at that point teaching and coaching people how they could implement IBC, which is infinite banking concept, in their own life, and use a whole life insurance contract to store their capital, and then leverage against that to do their investments, their day-to-day, purchasing a car, paying their taxes, and how you get to leverage both assets or both sides of the ledger instead of having having a policy or real estate. You get to have the policy and you get to leverage against it to have that real estate investment project. Hopefully that makes sense.
Yeah, exactly. And then can you kind of break down for, of course, myself, but also the audience who kind of want to hear from like a granular level of kind of like the mechanics and how would that flow? So we start off with, work with you to get the policy, which is like step one. But what as far as kind of the steps in order to kind of, I say for an example of buying into buying a rental property, for example?
Yeah. So first off, I'll say you got to start with education. Education is where it all starts with real estate or anything else you do in your life. And there's no difference here when you're wanting to try to implement infinite banking concept. But the first thing we do is when people have interest or want to learn, I say, okay, you need to read Becoming Your Own Banker by Nelson Nash. And anyone who emails me at harper@createtailwind.com, I'll send you a free copy of the book after I maybe call you, get to know you a little bit, right? So you can read it. And then after you read that, you'll have a decent foundation and framework to build off of. And then you'll have some questions and different things that are intriguing you or you want to learn more about. At that point, then we'll do a one-on-one presentation to see if this is something for you or not for you with me and Jim Oliver, right? Just a 30, 45 minute or an hour overview. At the end, you may have more questions, may have them answered, look for the next steps. But we're not here to sell you. We're here to educate you. And, some people, it's taken years for them to come around and do it. Other people think it's not for them, and that's totally fine. There's nothing wrong there, but we're here to just educate and talk to open-minded individuals who are interested in the concept. Now, that's kind of like the baseline there. But if someone's wanting to get started, here's how I say to have an overview to look at it. Think of a T-chart, kind of like credits and debits or assets and liabilities, and you're going to kind of have two sides to that ledger. On the right side of the ledger is what you're already doing. You're already flowing your money for your lifestyle, for your day-to-day, expenses, right? Your taxes, your savings and investments. Okay. So let's say we'll focus on those savings and investments, which could be cash flowing real estate, apartments, storage units, real estate flips, whatever that may be, syndications, passive investing, yada, yada, fill in the blank. Then on the left side is your money pool. That money pool, right now for a majority of people is someone else's bank, which could be a checking account or a savings account at Bank of America, Wells Fargo, their regional bank, fill in the blank there. But what we're wanting to do is we're wanting to migrate those funds over and sit them in a specially designed whole life insurance contract with a mutual insurance company, a specific mutual insurance company, right? There could be 5 or 7 I would consider working with, but we work with 2, which are Emeritus Life and Lafayette Life. And they really understand what we're doing. And we want someone who wants to be in the game, so to speak, and advocates for it. And there's a lot of other things you want to factor in there, which I can get into, but we're starting to talk about the product now, or the platform, which is the whole life insurance contract, where we're going to store the capital, our capital, which would be our warehouse of wealth, right? Our destination where our capital is going to sit at before being deployed and sent back to sit before being redeployed. Okay. And when it's sitting in there in this whole life insurance contract, that's the product or platform. If we're not deploying it anywhere, it's just going to sit there. It's going to compound tax-free, uninterrupted. It's going to be, depending on the state, quite creditor protected. And it's going to have no tax return you're going to file if it's designed properly. And so it's kind of off the radar as a nice private, safe, liquid asset that you have to your tool belt. And whether you have a real estate deal in 3 months, 6 months, or 5 years, it's going to be compounding. Let's say a couple percent a year, 4%, 5%, depends on the year and what's going on. And as that's going, you're going to still have your behavior and your assets on the right side. Now, IBC, or infinite banking concept, is us changing the flow of our money and bringing both sides of the ledger together. So IBC is the process. The whole life insurance contract is the product or platform, which will perform well over time if it's designed correctly with the right product and the right company. But when you put them together, that's really when you're starting to leverage both assets, your behavior, real estate, right on the right side, and then of course your policy on the left side. So you got the two things, process and the product. That makes sense?
Yeah, absolutely. And then as far as you had mentioned a whole bunch of different type of real estate investments, passive investments, multifamily, self-storage, but also even other purchases. You mentioned taxes, cars, other different kind of larger purchases. I include, is it like college, education, things like that? So any kind of major large purchases, and using, instead of the traditional side on one side, you're using on the other side to be able to flow your money in there to make those purchases.
Yeah, and what we're really focusing on with CreateTailwind is we know how to set up the policy or policies the right way, the right company. We got all that covered. What we really focus on is that banking function where you're crossing over the plane on the ledger and connecting the left and the right side, and you're practicing IBC. That's where we're going to coach you, and we coach you indefinitely after a policy is set up. We'll coach you indefinitely on that with no extra fee, right? Because the insurance companies are the one that compensate us. And we want to make sure you're educated, understand what's going on. And when we do our annual reviews and follow up with you throughout the year, we're going to help you, with all the banking parts of it and how to go through that process. So if you feel like that's a decent foundation, I can dive into like a real life example on how it could be implemented.
Perfect. Yeah, that was actually my next question. So if you can get into that, that'd be great. So people can see what it can look like, in a real life scenario.
Yeah, sure. Okay. So let's say we have the policy set up and we have cash value set up in there, right? So you start up a policy, there's two different kind of policies, right? You got a term insurance policy, which you're just betting against the insurance company for a term, a period, and you have no other living benefits. You're not going to have, the only benefit's death benefit. You don't have the cash value, don't have the access to use the cash value because there is none. You don't get the extra illness protection, things like that, right? Depending on the situation. But with the whole life policy, you're going to have part of the policy, which is going to be the cash value. So we're going to design it to where it's more heavy on the cash value, but not too heavy. And the reason is you don't want to go too far on either of the spectrum. So the traditional whole life policy is going to be set up to where it's not that quote good of an investment. Now this isn't an investment, but it can hold up well against other investments if it's designed, properly and funded the proper way. But we also don't want to fund it too much because there's issues over there as well. But I'm not going to dive into all those details or specifics. That book will dive into it, and I can talk one-on-one with people at more specifics as well. But I'm trying to focus more on the concept and the overview. So let's say we got our cash value in there. Let's say we have $100,000 in there. Okay, we can leverage up to say 95% of that, and we can leverage that within say a couple of business days, 3 to 5 business days. So let's say we have a real estate deal. Okay, let's say the real estate deal is $500,000. Okay, and we need approximately $100,000 for the down payment, right? So we call the insurance company and we say, hey, we want a policy loan in the amount of X. In this case, say $100,000. Yes, maybe you can get a little under $100,000 because they'll withhold a year's interest payment or whatever. But for simplicity, we're going to borrow $100,000 against our cash value in the policy. So when we get those proceeds sent to our bank account, which would be, a brick and mortar bank, like a Bank of America, Wells Fargo, wherever you're banking, Those funds are now in your account via ACH or wire. But your cash never actually left your policy. It's still compounding uninterrupted tax-free. Now, of course, there is a cost for that money because it's not your money. It's OPM. It's other people's money. Mm-hmm. And at the current rate, depending on the company, is about 5% simple interest, right? And you control that loan. There's no credit check because it's guaranteed by your cash value, okay? And you can repay whenever. There's no prepay, and it's very easy to be able to pay that back, and you control it. So you got the liquidity, use, and control of those funds. When you get those funds, now we're going to take those funds and we're going to place them in the real estate deal, okay? So once you put it in a real estate deal, you get to use those funds to say the down payment or capital needed, and the bank can leverage the other, say 80%. So put 100 in, the price is 500, and they leverage 400. Let's say you're making 12% on your money in that deal. Cash on cash is what I'm speaking. Then now what happens is you're going to set up a loan with yourself to the entity or yourself in the property. So you're going to have kind of two loans going on. One with you and the insurance company, and those funds will get deposited in your bank. For accounting purposes and bookkeeping, we typically will set up a new checking account and title it, say, Harper's IBC account, right? From Harper's IBC account, we'll use OPM, which is the insurance company's money that they leverage the line of credit against your cash value, and then loan that out to, say, that property. And let's say it's an LLC, okay? So now you have a loan out there, and we set up loan documents. So we actually help you with this and set all this up. But we'll set up an amortization schedule, right? Just like you were go to lend to someone else or a bank lends to you, there's going to be a promissory note and an AM table that you're going to follow, amortization table. So let's say that 100K, depending on what the cash flow payouts are, maybe that we pay it back over a 5, 7, 10-year period. And what's the market rate to borrow like that from an individual? Well, maybe it's 8, 10, 12%. Let's say it's 8% in this perspective. We're going to amortize, let's say over 10 years at 8%, okay? And we're going to honor that just like if we had that with a third party or a bank. You got to pay it, got to finish that payment. But they're two separate from the insurance company and you, and then you and the real estate deal, okay? So then the real estate deal, as it produces cash flow and income, you'll start sending back those payments to you individually. So it'll be a business, expense. They gotta pay back the person who's lent the money, right? Back to the lender. So the borrower pays back to the lender, which is just you and your entity paying back to you yourself. Mm-hmm. You're receiving that, right? So you got that coming in. It's going to come in at 8%, but it's amortized. So it's going to be top heavy volume of interest, because when you amortize it and you look at the amortization table, it's going to be much higher than the 8%. There's using that to amortize it. So you're going to have money coming in quicker than you're going to be accumulating interest here, which is simple interest. And you're going to start paying down that policy loan and policy loan interest with those payments once you get them to your IBC account. So what you have is you have your policy compounding the whole time, income tax free, right? You have a policy loan outstanding that is accumulating interest. It's simple interest, say 5%, but you're paying it back. And then now your simple interest being charged is diminishing, but you're now taking control of that banking function and sending it back to your policy, right? While your policy is still compounding over here off to the left side of the ledger. So what you have here now is every dollar you're paying back, that line of credit opens back up and you can relend it again, just like how a bank does. So I know some of these are long-winded, but I'm trying to go through more of the details so people can kind of visualize in their head.
Yeah, absolutely. And like I said, I highly encourage you to go to your website or contact you directly so they can first start with the education part of it, because I know probably a lot of this stuff is very high level, and I'm trying to follow this. I definitely understand the concept. I know there's a little small nuances, but you also mentioned that your company also walks through if you're going to set up a transaction like that. So then you guys help us through the initial process of setting up the policy, but also help us through to the next step, because I know a lot of people will probably value that type of assistance there. And as far as and I don't know if it's a silly question, say if you had your 100,000 in there, is it smart for you if you're having cash flow from other investments and you have chunks of cash to continuously fund into the policy, so you can be able to now leverage that and then earn a higher rate of return from the policy itself, so you can kind of repeat the process?
Yeah, of course. And this is kind of how it's set up. So let's go back to the policy design. And let's say we're putting in You can take a zero away. You can add a zero. We have people putting in 5 or 10,000 a year. We have people putting hundreds of thousands or millions a year, right? So it's all over the spectrum in premium. So notice we're not focusing on the face amount or death benefit. We're focusing on funding our own bank or building up our own bank and capitalizing our system. So let's say you're funding it for 100K, or an individual's funding their account for 100K. We'll design it this way. For, let's say, for a 10-year horizon, just to give a snapshot, this will be paid till age 75, depending on the product, right? But we're going to focus on beginning years so you can kind of understand and visualize in your head. So you're going to fund 100 grand, let's say, in premiums. Well, year one, we'll fund 100. Year two, we'll fund 100. Year three, we will. And year four, we will. Year five, we'll fund approximately 40,000. And the reason we do that is because the policy starts to become marginally efficient. There's something called cash